Today we're going to be talking to a company which has delivered a very solid Q1 FY27. Prices holding firm. Can they continue to hold firm or not is really the question. We're going to be talking to the management of Aarti Drugs. Let's quickly, first off, look at the background of the company. It's a classic API story which is turning towards higher value-added products, essentially, and it was founded in 1984. It's part of the Aarti Group, Mumbai headquartered. It's one of India's largest manufacturers of active pharmaceutical ingredients, APIs, and it makes the bulk drug molecules that go inside tablets and capsules worldwide, not just in India. Market cap is currently at 4,000 odd crore. The story, every medicine has to start with a molecule, and that molecule is what helps, which is called the API, is what helps the patient recover. Essentially, before the tablet is made, someone synthesizes the active drug substance. The substance is called API, which is active pharmaceutical ingredient, and Aarti Drugs essentially makes that substance. What's an API? It's a specific chemical or a biological molecule. The molecule interacts with the body of the patient to produce the intended effect in terms of the therapy. And what it does, it cures illnesses, eases pain, and manages the disease, and or one or all three of these. The three businesses essentially of Aarti are: one, API manufacturing, which is roughly 80% of the revenue. Then you have formulations via the Pinnacle Life Sciences subsidiary, which is essentially forward integration. You convert API to tablets and to capsules. And then you have specialty chemicals and intermediaries. And that's how essentially the portfolio is structured. Let's talk about API manufacturing first. It's bulk drug substances sold to formulation companies worldwide. It's typically carried out in terms of manufacturing in volume or scale. Really, that's the essence of it. It's a high repeat business. Once you qualify for an API which needs to be sourced from Aarti Drugs, very rarely will you see switching, and it's the core and the original business of Aarti Drugs. Let's talk about formulations, which is the finished tablets and capsules business. This is primarily an export business to Europe, US, and regulated and emerging markets. Higher margins than the API, but it also carries its set of regulatory risks. Then you have the specialty chemicals and intermediaries business, which is specific chemicals, and largely the new one on the block is methylamines. That's essentially the business which they are looking to tap into, which should allow them, again, forward integration towards drugs which they currently manufacture. Let's talk about the portfolio before I get into methylamines and the like. The API portfolio is let's start off with the most basic one, which is antibiotics. It's the largest therapy technically for most businesses, and for Aarti it's no different. Then there's anti-diabetics for diabetes. There's anti-protozoals. Now this is nothing but it treats infections caused by protozoa. Protozoa, single molecule creatures which create these infections, and antiprotozoals are antibiotics which are used to cure that. Then there's antifungals, which treats fungal infections, anti-inflammatories, which treat inflammations, and then there's cardiovascular and CNS, which treats heart conditions and blood vessels. Any anomalies or worries over there get cured by the cardiovascular portfolio. Now, the key among all of these is the Sayakha plant, which has been put up. Sayakha is a place, and they've basically built a methylamine plant at Sayakha in Gujarat. What is a methylamine? It's a basic chemical input required to make metformin. Now, typically, metformin was made by Aarti Drugs here, but methylamine was imported, and as a result of which you had a high dependency, external dependency, and due to which there used to be a margin compression. Mind you, 60% of the value of the drug itself, which is metamorphin, used to be your methylamine, which is essentially why backward integrating it was extremely important, which is exactly what Aarti Drugs has done through the Sayakha plant in Gujarat. Now, It's obviously cheaper to build it in-house, plus your margins come in, and plus they've backward integrated methylamine as well, which kind of ensures that there is a better flow of raw material coming in, and there's lower dependency externally, plus you get better margins. So both of those are helping. It's a twin lever essentially, which should help Aarti Drugs going forward. They've ramped capacity up, but of course there is still scope for a further ramp up. They were currently at the end of Q4, they were 40% plus in terms of capacity utilization, ramped up towards 60% plus in Q1 FY27, and can get to 70% plus. And this is a clear margin trigger for Aarti Drugs going forward. So we'll get a sense from management as to how this plays out. Let's talk about where Aarti Drug sells to. And where it sells to is, one, domestic is 62% of the revenue, 38% is international. Even within the domestic market, it's high volume but low margin. That's the way the business is structured, at least domestically. For the export market, they export to Europe, North America. I spoke about those, but they also export to Brazil, Mexico, LATAM, Egypt, Nigeria, and other markets in Asia as well. There's Indonesia, Southeast Asian markets. So regulated markets within the export pie is approximately 75% of the total, and therefore, and harder to penetrate also, therefore, the moats are stronger in regulated markets. That's how you see it. In terms of the business model, well, they generally, at least the API part of the business the selling happens in tons and not in tablets, essentially. So that's how revenue and volume, it's a volume game essentially. Pricing varies by the molecule, quality, market destination and the like, and long-term relationships are also the moats. And switching costs are high, right? And therefore those moats are tough to kind of breach. The margin structure, raw materials are approximately 60%, especially the input coming in from China. It's crude oil linked, ammonia linked as well. Power, coal, utilities are also an important component of the finished product. And, you know, the EBITDA margins are roughly 12 to 13%, but there is scope for expansion. I mean, in the recent con calls, they've indicated that even a 14% plus margin could well be sustainable. In terms of the factors that have caused margin compression, I'll talk about that when I look at the financials. But let's start with the P&L account. And when you're looking at the revenue, it's been largely flat over the last 3 years. The EBITDA number also has been largely flat, and the profit has grown at just a 6% CAGR. So very unimpressive in terms of the numbers themselves for the moment. And let's look at the margins before I take you through why the numbers are what they are. The margin trajectory, when you're looking at it, they've largely been in the 11 to 13% margin bracket. There is a possibility now of a margin upside because you're starting to see near 14% in terms of margins. Plus the Sayakha plant should add to the margins, which we spoke about. Now, let me tell you as to what are the factors that have caused the kind of slowdown that it has since FY22. One is China API pricing. China has been dumping API at far lower prices, due to which it causes an impact on Aarti's margins. What the other piece is crude oil-linked derivatives since FY22 have been very choppy, given Russia, Ukraine, and now the most recent West Asia crisis. The Sayakha plant, in terms of when it started off, there were some losses because when you start a plant, of course, the expenses are higher and it takes some time to kind of ramp up. And those losses got recognized in FY26, but now things are turning. The domestic antibiotics market was also, there was weakness there. And then, of course, there's West Asia, which is the most recent possible headwind. Let's talk about the balance sheet now. In terms of the balance sheet, you're sitting at around 1,550 crore in terms of the book value. The debt sitting in the balance sheet is around 575 crore. There's a 200 to 300 crore of capex annually, which Aarti Drugs will continue to do. And therefore, that debt number should be closely watched. There's also a cash bank balance of around 10 crore odd, which is sitting in the balance sheet. By the way, debt is both short-term and long-term, excludes lease liabilities, which is very, very small. Talking about return ratios, they're roughly trending between the 15 and the 12% mark. Of course, there has been FY22, which was a very solid year, where it was 21%. Mind you, margins also at that time were at 21%. So ROCs are largely tracking the margin picture as well. As margins fall, your ROCs also obviously fall, and that's exactly what's playing out on the numbers. Also, the 12% FY26 margin drop is also because of the fresh capex which they've done, which has entered the fixed asset base. Talking about the shareholding pattern, you've got 54% promoter ownership, you've got 2% FIs, 10% EIs, 34% public. That's how it's structured. This is fairly okay because you've got a healthy promoter ownership there. Valuations currently trades at 17 times 1-year forward earnings. 5-year average is also 17 times. The 5-year range is 10 to 22 times, so it sits somewhere smack in the middle, neutral with regard to valuations. Talk about analyst recommendations. Just one analyst from Dollar tracks this one. You've got no buy, no hold calls, no sell calls. 8% upside is what he sees on this one. What I'll do is slip in a very short break. On the other side, we'll have Adish Patil. He's the Chief Financial Officer and the Chief Operating Officer at Aarti Drugs to speak to us about how business is turning out Q1 and what the trends for FY27 look like. Adish, we'll come straight to you in a couple of minutes. Stay with us. Welcome back, and we're joined by Adish Patil. He is the CFO and the COO at Aarti Drugs. Adish, great having you. Let me start off with Q1, right? It's a strong set of numbers, 17% growth. Volumes have also, delivered. You've delivered both on pricing and volumes. How sustainable is this move?
Hi, good afternoon. So this quarter was the major event was obviously the US Iran war, and the prices started going up on the account of short supply of raw materials from the month of March itself. So March month, April month, and then the May month, the prices were maximum, and then the prices started cooling off a little bit. But still, they are quite high as compared to the previous quarters. So obviously, when there is a sharp hike in the prices, typically the purchasers refrain from purchasing. They try to postpone their buying decision. So that affected quantities a little bit, but yet we were able to deliver a 3.5% volume growth year on year. But the pricing growth was almost to the tune of 16%. And the main reason was because of the shortage of raw materials.
Right. And therefore, I mean, so while volume growth for you at 3.5 still looks impressive, just given the kind of pricing, give us a sense whether you can clock 10 to 15% volume growth this year, which is your guidance, or would the strategy change in any way?
Yeah. So the thing is, the situation had gone back to normal a few days back, but again the war started. So once the situation is back to normal, we still hope to have a 10 to 15% kind of a volume growth. That is our target. Now, what will happen going forward is that if the situation remains choppy like this, then there will be more value growth than the volume growth. So overall, we still, when I say value growth, more because on the account of rate variance. So we still feel that we should target a value-wise growth of roughly around 10% plus for this entire financial year.
Okay, a value growth of 10% plus, and then a volume growth of 10% as well, likely. That'll get you to 20% plus in terms of the growth clip, which is far stronger than what you've guided for. Is that the right way to think of it?
No, let me clarify. What I meant was
Okay.
our original target was that we were planning to have a 10 to 15% volume growth, and the rate variance would have been zero. I would say zero as compared to FY26. So overall value growth was estimated as 10 to 15%. But then what happened because of the war, the growth in the volumes got affected. But at the same time, it was made up by increase in the rates. So we still feel that overall value growth including volumes as well as the rate variance, will still somewhere between 10 to 15% in the current market situation.
Understood. And how are things changing on ground? So if crude prices were to spike, how does that translation of that to value work? Just give us a sense. Is there a mechanism you have in place? Because your clients are largely recurring clients. They will likely place orders based on price. But how is price evolving? Give us a sense of that.
Yeah. So, as you said correctly, that almost around 70% of our portfolio is dependent either directly or indirectly on crude prices. However, the change in the crude prices doesn't reflect in the raw material prices and the solvent prices immediately. There is a lag of 1 to 3 months depending upon the inventories at the various suppliers in the supply chain. So what happens is that even we have pending export orders for almost like 3 months, and then domestic pending orders are roughly around a month or so. So there is some level of so for this period we cannot increase the prices immediately, but whatever new orders we take, that definitely is based on the markup on the raw material prices. So, so that is the reason why we never engage with our customers uh, for a long-term rate contract. We always keep the rate flexible. Means after every 3 months, we should be able to revise the rate based on the raw material rates.
But then you've done very well on margins, Adish. You've actually done fairly well on margins. That should that likely sustain all through the year, FY27, 14% plus?
Yeah, so the EBITDA margins, 14%, we were always giving the target of that, and we hope that it will sustain. Uh, but what has happened is that we did not achieve the volume growth in June quarter like we expected. But because of the rate growth, we that helped us in the EBITDA margin growth. But going forward, when the volumes go up, that will also help us in getting out operating leverage and increasing the EBITDA margin. So we think that 14% EBITDA margin is quite doable for the company. And going forward with more regulated market sales, with the oncology business coming in the formulation, although the exports of formulations are increasing, so all that put together, our margins should move upwards above 14%.
And metformin in particular, how is capacity utilization evolving there? You've gone from 40 to 60 is my understanding. How quickly can it go up to 70, and what impact does it have on top line as well as your margins?
Yeah, so I think we are talking about the Saika plant which we put up recently. So that was about the backward integration for the metformin API. Metformin API we manufacture at a different site, and in last September month, we started with this new greenfield project. We commissioned and started manufacturing. So December, March, and June, steadily we kept on increasing, and in June quarter we reached slightly above 60% capacity utilization. Though I would say only roughly around 25% of the intermediate was captively consumed, and rest was procured from outside. And going forward, in you can say in next 1 or 2 quarters, that it will completely reverse. Means almost 75-80% of the intermediate should come from captive consumption, and 20 odd percent from the external suppliers. We will keep the external supply on because of the for diversification and risk mitigation point of view. So there is a lot of scope to improve our margins for that facility as well going in for next 2 quarters.
Could you tell us that at 60% and normalized pricing in the environment, what would your normalized EBITDA margin be for metformin and the forward integration that you're using metformin for?
Okay, so we were already making around company level EBITDA margins for metformin even before we launched the intermediates for metformin. So the plan is we will be captively consuming that DMHCl for our metformin, and rest of the methylamine products we are selling outside, and that is why you can see a sharp jump in the spec chem volumes for our company in last quarter, and that will continue to remain throughout the year, and in fact it will grow further as the utilization of capacity goes up. And as far as the metformin is concerned, because of this Saika project, it will definitely improve our gross margins further. That is what we are expecting.
What is your captive consumption ratio for the moment? How quickly can it get to 80 to 90%? If you can give us that perspective.
Yeah, so last quarter we roughly did around 25% for the product of metformin, and we expect that within 2 quarters it should reach to 80% at least minimum.
How quickly can you get to 15% EBITDA margin, just realistically speaking?
15% EBITDA margin, I would talk more on the quarterly sense rather than the entire year. Uh, it should happen somewhere, in the next financial year, in FY28. It is more likely to cross 15%. This particular year, our target is to go above 14%.
Okay, excellent. Adish, thank you so much for joining us. We'll let you go on that note, and that gives us a good perspective of how the business is evolving. Of course, there's plenty of chop and churn, and the uncertainty, of course, remains. But keeping one eye on the ball, you have a good perspective of how Adish is looking at progress on various other parts of the business. Timed out on this edition of All About Your Company. Thanks so much for tuning in.